Hello everyone, welcome to FISC Financial Strategy Consultants. Today we are going to discuss LOS 6 of reading number 30, CFA level 3. Here we will study about different estate planning techniques. One of them is generation skipping. Generation skipping means if you want to give something to a third generation, that means your grandson or granddaughter, it would be better to give it directly to him instead of passing it through your second generation, that means son or daughter. So the reason behind this is that if you pass it to your son or daughter, that means second generation, they will incur a tax on the estate, their inheritance tax. Then when they pass on it to their children's, that means your grandchildren, that will be again tax become taxable. That means you will have to pay tax twice for the same estate which you are eventually going to pass to your grandchildren. So it is better to directly pass it to the grandchildren and save a tax. So here we will look at it in an example.
Now we will look at an example of generation skipping. In generation skipping, the question you can see on your screen is: assume an expected after tax return of 5% on an assets that will be ultimately transferred to the third generation from second generation. We will assume that first generation will transfer the assets to second in 15 years and second will transfer it to third in 30 years. Tax on inheritance is 40%. Now, you can see here, if we don't go for generation skipping, this was the time when grandfather had, the first generation had the money and he transferred it after 30 years to the son, the second generation. So 30 years of compounding, 40% taxes, the rest amount goes to the second generation, which again compound it for 15 years and then it goes to the third generation with 40% tax. In such a case, you can see the present value will be of that estate of that bequest is 3.2344 times increased, means it will be 3.2344 times of the present value. Now if we go for the skip route, you can see that the compounding will be for 45 years and after that it will go to 60%. Okay, so in such a case the compounding will result in 5.3910% times of present value. So the factor of increase in the value because of this generation skipping is 1.67, which is same as 1 by 1 minus t. This, so you can understand how you can get benefit of skipping a generation if you already have thought that you want to give this amount, a particular amount, to your third generation. There is no need to pass it to your second generation. That's all the case.
The next topic is spousal exemptions. Spousal exemptions is like when one of the spouse die, they do under spousal exemptions. The other person, the other family member can pass the estate without tax, some of the estate without getting a tax. So, for example, in UK, 312,000 pound can be passed on to their son or daughter by the surviving spouse without incurring any tax on that bequest. So that's called a spousal exemption. Here in this example, we have a family, Will and Samantha. They have an estate of 700,000 pound. Now, what happens if Bill dies? If Bill dies in UK, they can give Samantha can give 312,000 pound to their son or daughter. So then their taxable income on their taxable estate would become 388,000 pound. That would be much lower than the actual amount, and that would reduce their taxation when they give it as a bequest. Now, the third part is valuation discounts. So you have already known about valuing securities, valuing assets, stocks in the market. Now, what happens if the person has a private company and that is what he wants to pass it on to his son or daughter, his children? So in such a case, they don't have a correct value of it because it is not trading in the market. So what they will use a valuation model to value the to identify the very fair value of the company. Now, since the company is private, you already know about illiquidity discount that would be applied on this valuation. Similarly, there is a chance that the father is not giving 100% control to the son or daughter. There, he may be giving only 20-25% of the control. In such a case, lack of control discount will also be implied on this valuation. So there will be two discounts which will be implied, and that would reduce the value of the company, and eventually you will have to pay lesser tax for the inheritance. So that's what valuation discount means. Now it is not a simple sum. So for example, in this case, suppose a business person want to pass on his estate to his son, which has 10% illiquidated discount and 15% of lack of control discount. That means total discount won't be 25%, but will be a multiple of it. That means 18% discount. 1 minus d1 into 1 minus d2, that is equal to 1 minus d star. D star is the actual discount will be which will be implied. Okay, so the last part is charitable gift. Charitable gift means passing your asset to a charitable trust, which is tax free. So if something is tax free, it is better to pass it on today. So here also you have a formula to calculate it, that whether the relative value of charitable gift is more than one, that means the charitable gift is beneficial as a than a bequest or not. So this is the formula which helps you in calculating it. I would suggest remember all the formulas, and this LOS, this reading would become very easy for you. So this is all in this topic. Please like, subscribe and share our channel it with as many people as you can, and please comment to let me know how you feel about this video. Thank you very much.